while you were sleeping comfortably, thinking you've got time to wait for rates to drop. A Trojan horse is being rolled right into the center of this market. And if you don't see it for what it is, it could quietly destroy your shot at affordable homeownership.
Yeah, here's what everyone does see. Rates are elevated because of volatility. Iran conflict, oil swings, bond market instability. Lenders are adding a risk premium. That's why mortgage rates are still sitting above 6.25%, even though the data says they should already be lower. And when that volatility fades, rates should come down. That's the part everyone's waiting for.
But that's not the real story. That is just a distraction, because everyone's focused on when rates will fall, and nobody's asking what happens after they do.
Yeah, that's the Trojan horse you talked about. The drop in rates, the relief, and then this is it moment. It could be the thing that pulls everyone back into the market right before the entire system changes. And the reason has nothing to do with inflation, nothing to do with oil. It has to do with how mortgages are funded.
We're talking about potential privatization of Fannie Mae and Freddie Mac. Right now, those entities act as government-backed safety net, helping keep mortgage rates lower by absorbing the risk. But if that safety net is pulled away, the private market takes over.
Yeah, and private investors, they don't subsidize risk. They price it in, which means higher required returns, which means higher priced long-term mortgage rates, not temporarily, structurally. We're talking anywhere between 0.25% to over 1% higher rates long-term if this shift fully plays out here.
So think about what that actually means. You're waiting for rates to drop, you finally see that window open, you jump in thinking you timed it perfectly, and then the rules change. Come on. The same rates you were waiting for, they don't come back.
Yeah, and so what looks like relief might actually be the setup, because this isn't just a rate cycle. This could be a complete system reset.
So, before you sit on the sidelines waiting for perfect conditions, you need to understand what the market is actually pricing right now and what it's not, because something in this data doesn't add up. And this is where we're starting. Anthony, there's something happening right now in the mortgage market that most people are completely missing. Because if you're just watching the headlines, you'd think rates should already be moving lower. And honestly, the data says they should be. You've got inflation cooling in areas, the bond market stabilizing, and mortgage-backed securities recovering off of recent lows. But when you actually go out and try to lock a loan, that improvement, it doesn't fully show up.
That's right. And when you look at the numbers, it becomes pretty clear this isn't a data problem, it's a confidence problem. Right now, the 10-year Treasury is sitting around 4.34%, and mortgage-backed securities, the 5% coupon, is near 99. That same coupon was closer to 97 recently. So we've seen about a 2-point recovery. Under normal conditions, that would push mortgage rates, and we would see lower for longer very quickly.
Yeah, exactly. So based on that recovery, you'd expect borrowers to be feeling that relief already, but they're not. And that disconnect is the signal, because historically, when bonds improve, mortgage rates follow, and they follow fast. So when they don't, it means something else is being priced in.
Yeah, and that's where the gap is showing up. With a 4.34% 10-year mortgage rate, we could be closer to 5.7 to 6%. But instead, we're sitting at 6.25 to 6.35. That difference, about 40 to 70 basis points, that's the lenders building in the cushion. So on a $500,000 loan, that's roughly $100 to $200 a month difference.
So the real question becomes, what are they protecting against? Because lenders don't just add cost for no reason. They do it when they believe there's risk ahead and it's higher than what today's data is showing. And this is where the conversation shifts from rates to control, because mortgage rates, they just don't follow the data. They follow the confidence and who is running the system behind it.
Yeah, and right now, the market is already acting like a changing of the guard is underway. You've got the current structure under Jerome Powell built on communication, forward guidance, and support when needed. And then you've got the expectation of a shift towards Kevin Warsh. Smaller balance sheet, less intervention, and less reliance on guidance. That's a completely different approach we're about to see.
And when markets sense that kind of shift, they don't wait. They price it in early, because from lenders' perspective, the risk isn't just where rates are today, it's where they could go if the rules do change. If the Fed steps back from supporting mortgage-backed securities, that removes demand, and when demand drops, rates go up.
Yeah, so even though the data today supports lower rates, lenders, they're still asking one question: what happens next? And the easiest way to protect against uncertainty is to widen the spreads, which is why borrowers are still paying $100 to $200 more per month than the data alone would suggest. And here's where it gets even more interesting and more important, because the biggest risk right now isn't what the market clearly sees. It's what it might be misreading. And that's exactly what we're going into next.
There's a moment in Troy where everything looks like it's over. The war feels done, the enemy is gone, and sitting outside the gates is a gift: the Trojan horse. And the Trojans do what most people do in that moment. They relax. They assume the danger has passed. They bring it inside and they move on. But what made that moment dangerous wasn't what they saw. It's what they misunderstood.
Yeah, and that same psychology showed up in the market back in February. Because if you look at the numbers then, they actually looked worse than they do today. The 10-year Treasury was pushing into the 4.0 to 4.5 range, but mortgage rates, they were still sitting around 5.8 to 5.9%. That felt like a strong market, but it wasn't. Lenders were compressing margins, trying to stay under that 6% handle, that psychological level, and betting on demand from what are called the GSEs. So GSEs are Fannie Mae and Freddie Mac, the government-backed entities that buy mortgages from lenders to keep money flowing in the system.
So what looked like strength was actually risk being ignored. They brought the horse inside the gates, thinking it was an opportunity. And then the moment the Iran situation escalated, everything flipped. Now fast forward to today. The data actually looks better, but rates are higher. That's the disconnect people are feeling today.
Yeah, and the reason it flipped is because lenders went from optimism to protection mode, and they did that quick. Now we're in what you'd call a fear buffer phase. Instead of compressing spreads, they're adding 20 to 40 basis points on top of what the math says rates should be, just to protect against war-driven volatility, oil shocks, and policy uncertainty. It's basically an insurance policy built into your rate.
So think about what's really happening here. 2 months ago, the market misread the situation by being too optimistic. And today, we're leaning the other way, being overly defensive. And sitting in the middle of all this is the real unknown, because now you've got two forces pulling in opposite directions.
Exactly, Manley. On one side, you've got those same GSEs, Fannie and Freddie, potentially stepping in and buying more mortgages, which would create demand and help push rates lower. But on the other side, the philosophy is tied to Kevin Warsh. He leans towards less support and a smaller balance sheet from the feds, which could push rates higher. So the market doesn't know which force wins, and instead of guessing, it's choosing caution. And that's the key. What we saw in February was optimism play out in real time. What we're seeing now is caution. So the real question becomes, how is that actually showing up on the ground? Are buyers pulling back? Are sellers adjusting? Are different parts of the country reacting the same way? Because it's one thing to see this in the data. It's another thing to see how it plays out in real markets.
It's our rate loan officers, and Pete was somebody that got me into this podcast. So now we've got to talk about the part of this that almost nobody's paying attention to. Because everything we've covered so far, the volatility, the spread widening, the hesitation, that's what's happening on the surface. That's the war outside the gates. But history tells you the real damage doesn't happen during the battle. It happens after the people think it's over. Because eventually, the volatility fades. The Iran situation stabilizes, oil settles down, and the bond market calms. And when that happens, mortgage rates, they should improve. That's the moment everybody's waiting for.
That's right. And that's exactly why this is so dangerous. Because the moment of relief might be real, but it might not last. Because underneath all of this, there's a structural shift building that has nothing to do with the 10-year, nothing to do with inflation, nothing to do with the Iran conflict. It has to do with how mortgages are actually funded in this country. We're talking about the potential privatization of Fannie Mae and Freddie Mac, the backbone of the mortgage system. Right now, they act as a government-backed buyer of loans, which keeps liquidity high and rates lower than they otherwise would be. And I'm sure a lot of buzzwords have been playing around the privatization of Fannie and Freddie.
So let's break down this in real terms. When you get a mortgage today, your lender doesn't just hold that loan. In most cases, it gets sold into a system supported by Fannie and Freddie. That system reduces the risk. That system keeps the money flowing. And most importantly, it keeps rates lower. But if the system shifts and that risk moves from government to private investors, everything changes.
That's right, because private investors don't operate like the government. They demand to be paid for the risk. And when they're forced to absorb more of it, they simply raise the return they require. That's where mortgage rates come in. So now, instead of rates being supported by a government backstop, they're being priced purely by market risk. And the estimates on that shift, they're very real. We're talking anywhere between 0.25% to over 1% higher long-term mortgage rates, all because of this shift. Once that transition fully takes hold, there's no stopping it.
So now connect everything we've talked about today. You've got buyers sitting on the sidelines, waiting for volatility to settle, waiting for rates to drop, waiting for that perfect moment. And that moment might actually come. Rates could improve, the window could open, but here's the problem. Nobody knows how long that window lasts.
Exactly, Manley. Because if the moves being made right now are leading towards privatization, which they are, then that relief could be temporary. You could see rates fall as volatility disappears and then climb straight back up as the market starts pricing in a world without government safety net. That's the Trojan horse. So the drop isn't fake, it's just not permanent. And if you wait for everything to feel perfect, you might step in right as the system resets and miss the best opportunity this market is giving you right now.
So the real question becomes, if the system might be shifting underneath us, what are the markets actually telling us right now? because we've talked about the volatility, we've talked about the misread between February and today, and now we've laid out the possibility that long-term rates could actually move higher, even if short-term conditions improve.
Yeah, and that's why this next part matters, because this is where we strip away the narrative and just look at the scoreboard, where rates are today, what's driving them, and more importantly, what the bond market is signaling next.
All right, now on to our ever popular The Mortgage 101 Market Dashboard. Let's go straight to the scoreboard because this is where everything we've talked about either lines up or completely falls apart.
Yeah, so starting with the headline numbers, a 30-year fixed mortgage rate is currently sitting at 6.32%. Now that's slightly improved from where we were, but still elevated when you compare it to what the bond market is doing underneath.
Now let's look at the engine behind mortgage rates. Mortgage-backed securities. The MBS 5 coupon is sitting around 99.01, down about 20 basis points today. And the 5.5 coupon is sitting at 100.84, also slightly down.
Yeah, so what does that mean, right? Today, a little pressure on the rates, but you zoom out, there's still strong levels. We're basically sitting right around that par range, which normally supports lower mortgage rates.
And that's the disconnect, because when MBS are sitting around 99 to 101, mortgage rates should be hanging around the mid-sixes.
Exactly. And that gap is still being driven by uncertainty, not fundamentals. And you can see it right there in the spread, sitting around 2.05%, over 2%. That's still wider than normal.
So bottom line, the bond market is stabilizing, but lenders are still pricing defensively. And until that changes, rates aren't going to fully reflect what the data is telling us.
Which brings us right back to the bigger question. Is this just temporary, or is the market preparing for something bigger?
All right, let's lighten up a bit. It's time for everyone's favorite segment, the Mortgage 101 Buzzword Breakdown with producer Ryan. Hey, Brian, what do you have for us today?
All right, boys, keeping it on theme this week. Let's see if the people actually understand what's going on behind the scenes. First up today, we have risk premium. Manley?
Risk premium is simple. It's the extra cost lenders add when things feel uncertain. Right now, that's coming from geopolitical tension and volatility, and it's why rates are higher than the data says they should be.
All right, buzzword number 2 is mortgage-backed securities. Anthony?
Oh, that's a good one. They're pools of mortgages sold to investors, and their price determines your rate. So when MBSs go up, rates go down, and vice versa.
All right, buzzword number 3 today, we have spread. Manley, tell us about it.
We talking about cheese spread, or what are we talking about here? Are we talking about the spread that is the gap between the 10-year Treasury and the mortgage rates? Normally, that's hanging around 1.6% to 1.8%, but right now we're over 2% because someone's taking a little extra spread. That extra gap is fear being priced into the system.
All right, buzzword number 4, GSEs. Anthony?
Yeah, GSEs, it's not an acronym for medication. It's Fannie and Freddie Mac, government-backed entities that buy mortgages from lenders. They keep money flowing and keep your rates lower. And if that changes, rates don't behave the same way anymore.
Right on. Number 5 today, we got Trojan horse. Manley?
Ooh, the Trojan horse is what looks like a good thing on the surface, but carries risk underneath. Right now, that's lower rates coming from volatility fading, which could pull buyers back in right before the system shifts.
All right, that one might have been the most important breakdown yet. Back to you, Manley.
Appreciate it, Ryan. And if you're starting to see how all this connects, that's the whole point, because understanding the game is how you stop reacting and start positioning. If there's one thing to take away from this episode, it's this. This market isn't just moving, it's potentially changing. And that's a completely different risk than most people are thinking about.
That's right, because everyone's focused on timing the rates, waiting for them to drop, waiting for the perfect moment. But what we've laid out today is, what if the system itself is shifting underneath you?
Because if you get that short-term drop and long-term rates reset higher, you don't get a second chance at that window. And that's why sitting on the sidelines right now could cost you way more than just a slightly higher monthly payment.
We're talking about missed appreciation, less negotiating power, and higher long-term borrower's cost, all because you waited for certainty in a market that doesn't reward it.
So if this helped you see things a little differently, hit the like, subscribe, and maybe drop a comment. And share this with someone who's still trying to time the market. Because the people who win in markets like this aren't the ones waiting, they're the ones positioning.
And here's something most people don't realize. Fannie Mae and Freddie Mac have been backed by the federal government since 2008. That's over 17 years of support. And the reason? Without that blocking, the mortgage market nearly collapsed during the financial crisis. So the government stepped in to stabilize rates and provide liquidity and keep homeownership alive.
So the system we all think is normal today was actually built in a crisis and sustained ever since, which means that if that support ever changes, the market doesn't just adjust, it reprices. Final mic drop. Don't confuse what feels normal to what is permanent.
Girl from the heart of Wisconsin to the waves of Hawaii. Manly and Anthony keep it real, not salesy. Breaking down rates and the truth you need to know with a little soul and a little homegrown flow. It's the Mortgage 101 podcast where real talk meets home and laugh. Manly's got that Midwest soul. Anthony brings that island roll when the market swings and you don't go fast.